This is a continuation of the previous video, and we are discussing the adjustments to be made to the final account. And we have looked at first four adjustments on the page, and there are three more that we need to discuss. So I'm going to now look at the fifth adjustment, which says salaries worth 1,000 and interest on bank overdraft worth 2,000 are unpaid. So additional, it says additional, there means there must already be an expense called salaries, and we have 11,000 rupees worth of salaries, and interest on bank overdraft, we do not have any interest on the debit column. Okay, so only the salaries are additional, and then interest on bank overdraft to 2,000. These are the two things. So let us go to the relevant slide. So salaries are 11,000, which is given to us in the trial balance, and now there is an additional amount of 1,000. The interest, on the other hand, currently you have not paid, 0, and the additional interest, or the interest which has not been taken into account, is 2,000. So all we are doing is we are using the matching principle. The matching principle says expenses of this year to be matched to incomes of this year. Salaries of worth rupees 1,000 have not been paid in this year. Cash has not been paid, but services have been rendered by the employees. So you have to pay the employees. Employees have a claim on the business. So the actual expense for this year is 12,000, and same for the interest on bank overdraft. You took the overdraft, the interest is due, you've not paid it. The accounts are prepared on accrual basis. So the two principles, matching and accrual, dictate that we show 12,000 plus 2,000 as the expense. Now what is going to be the impact? The first impact is going to be in the profit and loss account, of course. In the profit and loss account, in the second section, you have salaries. So you are going to show 11,000 plus you are going to show the additional 1,000. So the total amount to be shown for salaries is 12,000. And this additional amount is going to be called outstanding. Outstanding means unpaid. So this is unpaid salaries. Outstanding salary. So we're going to write that name here, and we'll do this when we do the practice problem. So this is the amount to be shown, and you have interest as well. Now interest, there was no existing amount already, so we're just going to show the outstanding interest. So we're going to write outstanding interest 2,000. That's it. So that is the effect of these two transactions. We just clubbed these two transactions which are of similar nature. The only difference is for salaries there was an existing balance, for interest there was not an existing balance. The other impact in the balance sheet is going to be on the current liabilities. Now if you have to pay the additional 1,000 within next 1 year, this 2,000 again within next 1 year, we're going to call this a current liability. So we will club this under outstanding expenses. Outstanding expenses and total 3,000. You could show them one by one as well. This is internal accounting. So you actually would want as much breakdown as possible. So you would show two different items. So 3,000 in the liability side. So the two impacts are in the profit and loss account we show on the debit side, and in the balance sheet we show under the current liabilities. Again concluding, there are two adjustments. There are two adjustments, each for salary and for interest on overdraft. These are two transactions clubbed into one. So if you think about, these are two separate transactions. For each of the transaction you have two adjustments, one in profit and loss account, the other one in the balance sheet. The trend is converting itself into a fact. So we can now agree that any additional information which has not been adjusted in the trial balance before, so any such adjustment is going to affect both the profit and loss account and the balance sheet. So it is going to go to one of the places, one of the sides in the profit and loss account, either debit side or credit side, and one of the places in the balance sheet, either asset side or the liability side. All right, let's go to another transaction 6, which has not been accounted for in the books. It says bad debts 5% on debtors are to be written off. Sundry means various. You club small debtors amounts to be recovered and you club them. So you have information that 5% of this amount will not be recovered. It's a bad debt. So we need to write off this bad debts. The words write off essentially mean that you have to show them as a loss. So writing off meaning that you can't any longer show the same amount of debtors. Let me look for the debtors and creditors here, debit side. 25,000 is the amount of debtors. You have to write off 5%, which is 1250. You can't show 25,000 as your debtors, as the current asset. It has to be reduced by the amount of 5%. So clearly one thing that we get from the transaction right away is that we have to reduce the amount of debtors which are shown in the balance sheet. So one adjustment has been identified. The other adjustment will be that you show this as a loss in the profit and loss account. Simple as that. So let me go to the relevant slide. Here, the amount of debtors in the trial balance is 25,000, and now there are bad debts at the rate 5%. So 1250 is the amount which you do not expect to recover. So 23,750 is the revised amount for debtors. This is the new amount which should be shown, and this is going to be considered as a loss. The loss goes to profit and loss account debit side, and the new balance is shown in the balance sheet. These are the two impacts. Let me illustrate them in the profit and loss account. You have two sections. In the second section, you are going to write bad debts. Bad debts 1250, and in the balance sheet, under the current assets, you show debtors. So you are going to show the debtors as 25,000, and then you are going to deduct the bad debts out of it, and you are going to show 23,750 finally as the debtor amount that is to be recovered realistically. So this is invoking the principle of conservatism. Whenever you foresee a loss, you adjust for it. So that's what we are doing. We know from our experience or from the new information that we just received that 5% is not going to be recovered. So again, these two transactions have effect on the profit and loss account and balance sheet both, debit side and under the current assets. So two adjustments made, one in profit and loss account and second in the balance sheet. All right, let's go to the last transaction. In fact, let me go to the trial balance first. So this transaction says there is depreciation to be provided on land and building at the rate 5% and on furniture at the rate 10%. To be provided means you have to reduce the amount, reduce the value of this asset. That process is called providing depreciation, providing for depreciation. Sometimes it's also called charging depreciation, right? So let me look for depreciation. There is no depreciation mentioned here, but there certainly should be building and furniture. So land and building is 30,000, furniture is 8,000. So 30,000 and 8,000, let me write it here, and 8,000 for furniture. This is land and building, let me write it in short. So the adjustment to be made, which we forgot to do earlier, according to matching concept, you have to show all expenses of this year in this year. Depreciation is one of the recognized expenses which you have to show in the as an expense in the profit and loss account. So the depreciation amount at the rate 5% for land and building is going to be 1500. You have to show this as an expense. At the same time, for furniture, you have 10%. So there you go. Therefore, at the end of the year, the balance in the land and building is not 30,000. In effect, the balance is 28,500. And for the furniture, the balance is 7,200 and not the 8,000. So if we do not adjust for the amount of depreciation, we will be overstating the value of land and building and furniture. Now, the depreciation is a recognized expense, and expenses are shown on the debit side of profit and loss account. So, in the profit and loss account, there are two sections. I will show the depreciation in the second section. So total depreciation to be shown is going to be 1500 plus 800. So 2300 is the total depreciation, and this is on land and building, and this amount on furniture. Again, you write the longer forms, and in the balance sheet, under non-current assets, you reduce the value of these assets. So when you show land and building, 30,000, you are going to take out the amount of depreciation 1500 and then show 28,500. Same for furniture, you show 8,000 minus 800, so the net amount that you show is going to be 7,200 in the books of accounts. So you in fact show in the balance sheet, you show the final numbers, and there is a attached annexure to it, or a note, which we have seen earlier in the earlier videos. There you have the depreciation to be charged on all the various types of assets. So at one place all the details are provided. But the adjustment is again affecting profit and loss account on the debit side and the balance sheet under non-current assets. So two adjustments, one goes to profit and loss and other goes to balance sheet. So this is true. All the adjustments that need to be made go to two places. Now, why is that happening? The reason that is happening is that all the adjustments are they were supposed to be written through the journal entries, ledger posting and trial balance, that process, which is a double entry system, which means all the accounts actually affect all the transactions affect two accounts. For all the journal entries that you've written, you've already affected two accounts. But for these transactions for which the journal entry has not been written, they still have to affect two accounts. And that's how these transactions go to two places, one income statement, one in the balance sheet, and hence they affect, again, they take that effect of double entry system as they would have done if you would have written the journal entries and ledger posting and trial balance earlier. So to sum up, all the adjustments are going to go to two places, and compared to the balances shown in the trial balance, from the trial balance we have learned all the items go to only one place, either the balance sheet or the income statement. However, for the additional information, all the transactions go to two places, one in balance sheet, other in the income statement. So with that learning, I'll close this video, and I'll see you in the next video where we're going to take this trial balance and additional information, and then we're going to prepare the final accounts and make the adjustments on the side. I'll see you in the next video.